Hello, everyone, and welcome. I'm glad you're here today. We're going to spend some time exploring a topic that comes up in a lot of retirement conversations: indexed universal life insurance, or IUL. This is a type of permanent life insurance policy that has a cash value component. Understanding what it is, how it works, and where it might fit into a broader retirement strategy is what today is all about. Let's get into it. So, what exactly is an IUL? Indexed universal life insurance is a form of permanent life insurance. Like other permanent policies, it provides a death benefit for your beneficiaries, but it also has a cash value component, and that's where the indexed part comes in. The interest credited to the cash value is linked to the performance of a market index, like the S&P 500. When the index performs well, the policy may receive a higher interest credit. When the index declines, most IUL policies include a floor, often 0%, so the policy doesn't receive a negative interest credit that year. That floor is an important feature. But here's something equally important to understand. The floor applies only to the index-linked interest credit. It does not protect the cash value from being reduced by policy charges, the cost of insurance, or outstanding loans. Those can and do reduce cash value, regardless of how the index performs. And I want to be clear about something we'll come back to throughout this presentation. All values and projections in an IUL are non-guaranteed. They are based on current illustrated assumptions, and actual results will vary. Four features of IUL come up most often in retirement planning conversations. Feature 1. Index-linked growth potential. Cash value interest is tied to market index performance, so there's potential for stronger growth in good market years compared to a fixed-rate policy. IUL policies include caps, floors, and participation rates that affect how much of any index gain is actually credited. Review a detailed illustration with a licensed agent before making any decisions. Feature 2. Premium and benefit flexibility. Premiums and death benefit amounts can generally be adjusted as your situation changes, subject to policy minimums and carrier guidelines. Note that significantly reducing premiums can cause a lapse if cash value can't cover ongoing charges. Monitor this closely with your agent. Feature 3. Tax advantage treatment. Cash value grows tax deferred, and with proper structuring, policy loans may be accessed without triggering a taxable event. The death benefit is generally income tax-free to beneficiaries. Tax treatment depends on policy structure, MEC status, and individual circumstances. This is not tax advice. Consult a qualified tax advisor. Feature 4. Cash value access through policy loans. Loans can supplement retirement income or fund major expenses without liquidating other assets. They accrue interest, and unpaid balances reduce the death benefit, in some cases causing a lapse and a taxable event. Involve your agent and tax advisor in any loan decisions. Knowing what IUL is and how its features work is one part of the picture. The other part is thinking about how it might or might not fit into your broader retirement plan. Here's a 3-step framework for working through that with your advisors. Step 1. Evaluate your financial needs. What does retirement look like for you? Are you hoping to travel, start a business, pursue new hobbies, or simply maintain your current lifestyle? The answer matters because your income needs in retirement will shape how any strategy gets designed, including whether an IUL makes sense, and if so, how it should be structured. Step 2. Identify funding gaps. Take a clear look at your anticipated income sources in retirement: 401ks, IRAs, pensions, Social Security. If those sources aren't enough to cover your projected expenses, there may be a gap. An IUL's flexibility and tax advantage features may be one way to help address that gap as part of a comprehensive plan. But that determination should be made with a licensed agent and a financial planner who can look at your full picture. Step 3. Plan for longevity. People are living longer. A retirement that lasts 20, 25, or even 30 years requires planning for the long game. An IUL provides a permanent death benefit, meaning it doesn't expire, while also potentially offering access to cash value during your lifetime through policy loans. That combination can serve as an additional financial resource later in life, subject to policy performance and terms. Let's bring this to life with a hypothetical example. I want to be upfront. This is illustrative only. It does not represent the performance of any specific policy, and actual results will vary based on a wide range of factors. Meet John and Linda, a couple in their mid-40s who are thinking seriously about retirement income. They work with a licensed agent and fund an IUL policy early, which gives the cash value time to potentially accumulate during years when the index performs well. During the growth phase, their mid-career years, The policy's cash value grows on a tax-deferred basis linked to the index. As we discussed, caps and participation rates apply, and all values are non-guaranteed illustrated projections. They review their illustration annually with their agent. Then comes retirement. John and Linda begin accessing cash value through policy loans. When their policy is properly structured and hasn't become a modified endowment contract, those loans may not trigger a taxable event, which means they can supplement their retirement income without increasing their taxable income for that year. Their agent and tax advisor are involved in every step of that process. Again, this is a hypothetical. Please work with a licensed agent for an individualized illustration that reflects your specific situation, age, health status, and financial goals. Before we wrap up, I want to read through the disclosures on this slide because they matter and I want you to hear them clearly. Life insurance products are not securities, investments, or investment accounts. Indexed universal life insurance is a life insurance policy with a cash value component. It is not a direct stock market investment. All values, projections, and illustrated results shown in this presentation are non-guaranteed and based on current assumptions. Actual policy performance will vary based on index credits, policy charges, cost of insurance, and other factors. Past index performance does not guarantee future results. Tax treatment of policy loans, withdrawals, and death benefits depends on policy structure, modified endowment contract status, and your individual circumstances. Nothing in this presentation constitutes tax, legal, or financial advice. Please consult a qualified tax advisor and a licensed insurance professional before purchasing any life insurance policy. So, to bring it all together, IUL is a permanent life insurance policy that combines a death benefit with a cash value component linked to index performance. For the right person, properly designed and funded, it can be a meaningful part of a retirement strategy, offering potential for index-linked growth, premium flexibility, tax advantage, treatment, and access to cash value through policy loans. It is not the right fit for everyone. It is not a replacement for your 401k or other retirement accounts, and it is not an investment. But for individuals and couples who have gaps in their retirement income picture and are looking for a permanent life insurance solution with additional features, it's worth understanding. If you'd like to explore whether an IUL could fit into your plan, the next step is a conversation with a licensed agent who can pull a personalized illustration based on your age, health, and financial goals. Reach out to us at Crossfield Strategic Partners, Crossfield Partners. We would be glad to walk you through an individualized analysis. Thank you for watching. If this content was helpful, please like and subscribe for more on life insurance and retirement planning strategies.